Welcome to today's event. Thank you for joining. We are here today to talk about how to raise deposits in a rising rate environment. I am joined by Kellie Swiger, Creative Director at LAFCU, Jonathan Fischer, Chief Operating Officer at Timberland Bank, our moderator, Stessa Cohen, who's a strategic advisor for Pivot Assets and spent 19 years with Gartner, Mike Triggiano, who's Executive Vice President at Velocity Solutions, and Jen Packard, our Chief Product Officer. Before we begin, I want to let you know that this is being recorded, and tomorrow you'll all receive an email with the recording and more information. Separately, during this conversation, if you have any questions, use the Q&A feature at the bottom of your Zoom window. Thanks again for being here. And with that, I'm going to turn it over to Stessa to begin.
Hello and welcome to all the participants in the webinar and to our panel today. I wanted to thank everybody for joining us because this is obviously a very hot topic around deposits. It's obviously a key foundation of banking as well. Without deposits, there is no bank. So we're going to get straight to it and talk about really the meat of what you're here for today. We're going to discuss the strategies that bank and credit union leaders can take in the coming year. First, we're going to take a look at the key factors that contributed to this new deposit competition. Then we're going to take a look at some different future scenarios that might play out. And then finally, take an in-depth look of the key strategies that I think all of us agree are important for banks and credit unions to remain competitive. So let's look at first the factors that affected this environment. I mean, we don't need a deep dive. Everybody is living the changed conditions. Just a couple of years ago, banks and credit unions didn't need more deposits. They were flush. People were saving 35% of their income. That's completely changed. Mike, can you talk a little bit about what you see going on in this area?
Yeah, thank you, Lori and Stessa, for the introductions and kicking off the webinar. There's no doubt that a lot has changed since the onset of COVID almost 3 years ago. You know, our economy was on stable ground. We've been growing since recovering from the financial crisis of 2007, 2008. Interest rates were at some of the lowest levels. And then COVID comes along, and at the peak of COVID, deposits and savings skyrocketed. Everybody was flush with deposits, savings, consumers started to see the benefits and started spending too, putting strains on other parts of the economy and supply chain. However, you fast forward today and that situation's flipped. Those savings and deposits have been reduced significantly, requiring financial institutions to grow their deposits just to maintain their existing portfolios. A year and a half ago, we were putting our hands up, stop, no, I don't want any more deposits. They were costing us money. So, and combined with the rise of rates, the significant rise in inflation, has even created a huge need for consumers to access liquidity. So a lot has changed in a very short period of time. A lot has happened to our economy, how we run our financial institutions 3 years ago, how we ran them the last 3 years, and how we're going to run them into the future. But super excited to talk about the several strategies that are going to be aimed at how we become better trusted advisors to our account holders, how we maintain relevance to them, and how to attract profitable account holders and grow those deposits.
Okay, I know there's another side to this, and that's around mortgages. A lot of consumers go to community banks, for example, and credit unions specifically for mortgages. And I know, Jen, you have some thoughts about how that situation has changed.
Yeah, I mean, if we look at just 2 to 3 months ago, and we look at the housing market, first there wasn't a ton available on the market, and I say 2 to 3 months ago because that's how quickly it seems to have flipped. But and now you look now, and houses are staying on the market for longer. They are cutting prices because the interest rates are so high that, you know, everyone's scared to take that leap at this time. When again, 2 to 3 months ago, you look at it, and there were bidding wars on houses. There were people were doing all cash offers. So that's just completely changed, and it seems to have changed very quickly because of the interest rates that are rising.
And critically too, deposits are necessary for banks and credit unions to make loans, right?
Correct.
I mean, so that's really key. That's really key. So let's move to looking at future scenarios for 2023. And as an analyst, I like to look in the future all the time, and sometimes I'm right and sometimes I'm wrong. But looking at the future, how should financial institutions shape their strategies, Mike, for these scenarios? What kind of scenarios do you see from your perspective?
Well, I think the big banks are going to continue some of the strategies that they've been using for years, which is the large cash bonus offers that number of us receive in the mail and email, etc. They probably see some success with that, whether it's short-lived or not is something we don't know. But on the flip side, none of us really have a crystal ball, right? How many of us anticipated what occurred almost 3 years ago? So things can change so quickly. I think the best thing for us to do is to really focus on preparing ourselves for the unexpected, and making sure that we're executing on all of the strategies that help a financial institution win. And certainly to win back the deposits and their share of account holders from those big banks. You know, community banks and credit unions offer a tremendous value to consumers, and we just need to make sure that as that community bank and credit union, we're able to compete on a level playing surface and provide a higher level of service and relationship with those account holders than the big banks can do.
So one of the things that I've seen in the past, and I'm sure you as well, is that banking and payments, products and services, and even the institutions have become more commodities or more alike than not. And what do you see happening? And anybody can jump in here in terms of that kind of sameness across the industry, especially in the United States.
Exactly right, Stessa. A lot of products are commoditized within the industry, which is why it's so important for financial institutions to find unique competitive advantages that they can leverage with their account holders to accomplish the things that they want.
And Jonathan, from your perspective, do you see like the ability of community banks to be able to start to not be part of this financial services blob, if you will? I don't mean to be offensive, but kind of like banks out there. Are you seeing this happening?
Yeah, I think one of the best examples I've seen in the last few years was the PPP program that helped small businesses get through this, and the banks and the credit union, the community banks and credit unions really helped the Main Street businesses get up on their feet, where the big banks kind of stumbled, and it was a challenge, and you know, it was everything was changing every day for everyone. And community banks and small credit unions really did step up, and they had the great people. They added the technology when necessary, and it just made a big difference. So I think we can continue to do that and make a difference. We just have to be proud of what we do and not be bashful to say, hey, we want your business and all that. But yeah, I think there's lots of opportunity out there for all of us.
Well, this is like actually one of my pet things that I write about a lot is that, for the new neighborhood banking, credit unions and community banks and mid-sized retail banks are already there. And you actually know who not just who your customers or members are, but who lives in your neighborhood. And I think that's the knowing is all about how to differentiate. You have to know what you're differentiating from and who you're doing it for. I think that's definitely true. How do you see this from the credit union end of things, Kellie?
Well, I would say, just continuing to be there for our members. They all have a financial journey. Our tagline is your credit union for life. And I think that is so true across the financial industry. Where are we helping them? What are we doing? How are we educating them on our products and services? An example, like for a CD, you've got pockets of members that they know exactly what they want to do with their money, and they're shopping around. They know they're looking for the best interest rate, but there's also other members that might not necessarily understand that maybe investing your money in a CD is a lot better than just putting it all into a savings account. So keeping that top of mind, keeping that in front of them so they know what to look for. I kind of look at it as a kind of like a financial happy meal. I'm not just looking for a cheeseburger, but I want like the fries to go with it and the soft drink and the extra little incentive prize that's in there. And, as we move along, those what you get in that financial happy meal is going to change. Sometimes it's different, sometimes it's better, but I think we can kind of look at it in that sense. And then what platform are we using? Like digital onboarding is great because you can really connect to those members from the beginning stages and then take them on that financial journey. I'm not just talking to you once, but how are we leveraging those processes and those products and services that you can benefit from on your financial journey? Like sometimes I might need an auto loan, sometimes I might need a CD, sometimes I might need something else. So, taking them along on your journey.
So what I'm hearing, just to wrap up these first two parts of our discussion today, is that, the economic situation has changed a lot, and that's changed consumer behavior around deposits and spending and financial services that they need. And that's going to continue to change. That is not static. It's not necessarily in the financial institution's control, right? And two, there are a lot of future scenarios, and they're going to involve a lot of what you already can do, a lot of things that you could do, and to use the technology to get us there. So let's use that as a great jumping off point. So thanks, Kellie, in terms of looking at some of these strategies that the bankers and credit union leaders are here to get, and I think is really the meat of this. The first strategy is about becoming a trusted advisor. And just before we launch, I want to remind everyone on the call, if you have a question, put it in the question chat and the Q&A piece, and we can pull that up if we can during the section, or at the end, we'll also have time for Q&A. So do you have a few opportunities for that? So the first strategy is becoming a trusted advisor. Now, I'm going to look at it cynically from an analyst point of view and go, okay, this is not a new idea. All right. Why now? And why is it going to work now?
That's great, Stessa. And yeah, I think that that's exactly right. But I do think that that's a critical piece to this, right? And I think that Jonathan brought it up too with the PPE programs. Like now is really the time to shine. That was product driven, but it was also how community and banks and credit unions really came together to get that program out quickly and swiftly to make it easier for businesses. And I think that you mentioned something too, Stessa, about that these interest rates are out of the control of the financial institution. And we all know that, right? But I don't think that a lot of consumers actually know that. Like they don't know where these changes are coming from or why, right? And I think this is a great opportunity for financial institutions to educate the consumer of why this is happening and what's going on, and then guide them to what they could be doing now, and why it matters to them, and what the biggest thing is, why it matters to them and the benefit to them. And just by educating them and getting in front of that with what they could be doing and the benefit for them, I think really does truly make a difference to consumers. And I think a lot of financial institutions have amazing information on their website, but I don't think a lot of people are going to the website. So just getting those communications out to their members and customers to educate them of what's going on. I think that's really important.
And to that end, I mean, the information they need is really when they're thinking about it or making a decision, right? Can I buy this thing? And if I don't have enough cash, should I use my credit card? Should I use some other short-term liquidity tool like buy now, pay later? And really, what's the difference, right? I mean, if you ask my 20-year-old son, he would probably say there's no difference, right? Because it's all on his phone. He doesn't have a separate card. So these things are actually may be becoming even more important. So how do you know what customers need? What kind of advice? I know at Timberland, you might have some things that you've been up to find out from customers, especially when they're not going to the branch, they're not sitting down with somebody.
Yeah, I think, pre-pandemic, we had that little, postcard on the lobby, and it said, tell us what you think. And, you'd get a couple hundred of those back a year. And, that was helpful, but we were talking to the customers every day. And so we get to hear that. And then the pandemic hits and you have no customers coming in the lobby. And you're like, well, I wonder what customers want. Do they want all the technology? Do they not? And so, it's kind of a scary thing, but we said we've got to find out what the customers want in a digital format so we can get the response back quicker. And that's kind of scary on one hand, but good on the, it's almost like as your kids get old enough, they can tell you your faults. And it's not fun to hear. Unfortunately, I give a lot of subject matter to my kids, but we had to go down that path where we said, okay, customers, what do you want? So we implemented the Evangelist survey solution, and we're getting a couple hundred surveys a month back, and it's telling us things very, very quickly.
Wow.
What they want. And one of them recently with the inflation is they want better CD rates, and as an example. And so we've been able to modify our rates based on our customers' response. But giving the customer a voice has been hard in some cases, but it's been very important to us to understand what the customers really want.
And I think one of the challenges, if not problems, that bankers generally have is that they think they know what customers or members want, and that there's an assumption. I'll never forget seeing a sign in a credit union that said platform with an arrow, and I was like, what is, and I'd been working in banking and I didn't know what that was, because who uses that word? So we think that they know something or want something. And so I think, Kellie started to talk about this, but education becomes really an important role in being a trusted advisor. I think the side question is, do you want your customers and members learning personal finance or about banking products on TikTok, from somebody, not you, but somebody on TikTok? And how do you get there? How do you use education to do that? Kellie, I think you have some ideas that you've been doing at LAFCU.
Yeah, education is key in this ever-changing world that we have, and the rates constantly changing. Getting that information before our members is essential. And staying competitive, not only staying competitive with the industry, but just what you're offering. And don't be afraid to stand out, do something different. It's when you stay within the norm and you just do the same thing over and over again and offer the same thing without a little bit of change up, that it doesn't give you that leverage. It doesn't give you an opportunity to stand out. So I would say just don't be afraid to do something different. One of the things that we're doing at LAFCU is we're offering a 13-month CD, which is a little bit different term than we've done before. So we're testing the waters, seeing how that's going to work out, and going from there. Another program that we have is called the Move Rate program, which we're putting a little bit of humor on this program. So it's move as in MOO. A little bit of history on that is we were established in 1936 for a loan for the sale of a cow. And so the cow is kind of like our little ambassador, but we're putting in a fun spin on it. But it offers our members the advantage to move their jumbo rate between a 24, 36, 48, and 60-month term. So that's another program. So we're gonna see how that works. But I would say, overall, with whatever we do in the financial industry, data is key. You constantly need to be looking at your data. That's gonna tell you where you've been in the past, where you are currently, and where you need to be. Maybe not in the far future, you might not be able to kind of judge it like that, but at least kind of gauge based on your strategies and your organizational goals and your communications, how collectively that all kind of comes together. And not just looking at your data like once at the beginning of the year, not looking back at it, working side by side with it, no matter what you're doing, seeing how your strategies are playing out. Are they doing good? Are they doing bad? Do you need to make alterations to them? And that's going to help guide you.
One of the things that I think customers may have had enough of, and I don't know if banks have yet, is that getting pushed out these products and services that they may probably not need, and how do you change that inside an organization that has traditionally been geared around that? One of the big complaints that I see everywhere in my life is people being fed up with large retail banks that don't hear them, that don't help them, they don't answer phones, there's no way to get to them. So how do you start using technology to be, use that data, use what you learn about them to push out the services when and where they need them that will actually increase the trust, I think. Mike, you wanna jump in here?
Yeah, I will piggyback on Kellie's comments about data. That is where you really have to mine the data to find out what products and services the account holders are looking for, and it's in the data. It doesn't matter if it's products related to savings and or CD or consumer liquidity or some sort of payments. Ultimately, we can find those answers in the data by mining the transactions of the account holders and figuring out what it is that you're using or not using. In many cases, it's what are the account holders not using where they could be using, educating them and offering them a very easy way of enrolling, signing up. It must be intuitive, frictionless, etc., which is really, really important.
So I want to jump in here. We did have a question from the audience about education, but the traditional education tends to be appealing and limited to older customers and clients and maybe business owners, as opposed to the younger customers and members that you're trying to reach. How are you changing up how you deliver this education and it might be actually looking at TikTok or Snapchat or whatever it is to be, in small components that are concise, meeting those needs around video that younger people tend to want. Anybody can jump in here.
Yeah, I'd say, being versatile in your communications, choosing just one channel is not gonna necessarily connect to the market that you're looking for. So being versatile and being open to being flexible and using different platforms to connect to the demographics that you want to reach out to.
Kelly, does your credit union use TikTok? Not to
We
put you on the
currently
spot.
don't, but we're looking into it.
Awesome. No, there's risks and advantages. We don't want to get into it. Do you guys use YouTube?
We do. Yep.
Okay. Yeah. So it's anyone who has any kind of child knows that they're addicted to these short videos, and their attention span soon will be about 20 seconds. But it's important to meet them there as opposed to forcing them into something they can't do. So, there are probably a lot of people from listening in right now that think there's no way that they can become a trusted advisor. They're pushing out, their products and services that they have, but how can they become and utilize this model? Mike, what kind of advice would you give to executives who are hesitant about pulling off something like this in their institution?
Well, there's a number of components to it. One is, and we've been hearing this for a long time, one is having the right technology to build that model so that it enables the bankers to have that relationship, whether it's through a chat mechanism, which might be convenient for some, but that's not going to catch everybody. Some may want the access to a call. Some may want email. So being able to provide a mechanism for all the different types of contacts that your account holders are looking for is really important. And having the technology in place to do that is critical, because otherwise you're managing all these different mechanisms for interacting with your clients without any one thing overseeing that. So that technology, obviously key part, whether that's part of building a trusted relationship or providing the right products and services.
Okay, so it could mean bringing in the right people, whether that's on voice or video or however it is, or the right technology. I mean, one of the things about being an advisor is being proactive, right? Nobody wants somebody managing their money who just sits back and says, oh, the market crashed yesterday. Not a good financial advisor, but same with bank products, right? Rates could increase. Can we respond to that in a timely manner? And I know we had a question, and we're going to get to this in a bit, around, rates, automating, rates. Like, if I want the best interest rate, get me into that rate you don't have to ask me, because I want that. And that kind of technology is advice, right? It's proactive. Jonathan, did you say something, but you were on mute?
Yeah, sorry. Yeah, I was just going to say, I saw one of the questions, and it talks about increasing rates, all throughout the bank. And I think I've seen a lot of different people use different methods. I've seen some just keep their CD rates fairly low and they just have one special rate. And I think we've generally increased most of the rates, and just to kind of help out savers. It's been a tough time for savers for a long time. And since banks, if you're asset sensitive, like we're making more money as rates go up in some ways. So we've been trying to give that to more customers, and it's just a challenge because there's an attack on fees, and rates are increased. It's just an unsettling time for customers. So I think anything we do to help them, that would be great.
Yeah, so this is like a really deep topic that I want to kind of move us on to the next thing around cash. And, one thing that happens with inflation is more consumers need cash. And despite unemployment, we still have ongoing inflation, and consumers are blowing through the savings that they built up over the last couple of years. What's something that banks and credit union leaders should be doing right now around addressing short-term liquidity, which is what we're talking about? I need money to pay my bills, to get through the month, the next 6 months. How do I do that without going to a payday lender? Right? Because that's really what's underneath this is I don't want to go to my customers to go to payday lenders.
Really good question, Stessa, especially when you think about the change in the economics over the last 3 years. But let's face the fact, the need for liquidity has been there forever, for beyond kind of traditional banking. People have always been searching for ways of getting access to cash or bartering or whatever it is. Today's pretty important because of the high inflation, high rates. It's even more difficult. And we at Velocity, huge proponents on the idea that banks and credit unions can help solve this need for our account holders by offering short-term small dollar loans, ones that can be provided in a matter of minutes, because we've got all of the data about the account holders. We know their direct deposit history. We know their transaction history. We know what their ability to repay those loans are. And we're probably to blame, this industry are probably to blame for the rise of payday lenders. As account holders walked into our branches or called asking for $500 or $1,000, we turned them away, or we said, hey, get a credit card. But we all know there's a large percentage of folks that don't credit qualify, so they wouldn't have access to those. So that's a big need for account holders, and that's an easy thing for community banks and credit unions to solve. For the attendees that are interested, we've got a client, actually One United Bank, that's got a lot of press as it relates to the Cash Please solution and how they're using that to provide liquidity to low income families.
So part of this isn't actually a new thing. I mean, microcredit institutions have been doing this for a long time, but banks and credit unions have kind of like ignored that. But it's taking this in and not saying, oh, we're going to give credit to everybody, but really using some tools to really qualify people on the basis of maybe alternative information that they have. Like they're always paying their rent on time, they're paying all their utilities, they don't bounce payments, that kind of thing. So that's interesting. I understand too that Timberland is doing some innovation around helping their customers with liquidity. Can you tell us a little bit more about that, Jonathan?
Sure. I mean, we're big believers in savings and helping customers save more money. And it's just such a challenge as the liquidity came out of the market a little bit faster in the last 6 months with inflation going up. We've been looking for a while for something that we can continue to add to our mobile application that customers can use. And we ran across a company called Plinkit that allows for customers to kind of a gamification a little bit of their savings program, and they can set up goals and they can penalize themselves or give themselves rewards and help them to save over a long period of time potentially. And it's a great way to start out, even if you can't get your mind wrapped around budgeting and things. But this tool is going to help customers really. It's almost like the old Christmas club accounts where people socked away $25 a month away for Christmas, but this does it digitally through the mobile app, and which I think is going to be powerful, and hopefully the younger customers are going to like that and gravitate towards it. But it's really a good solution, I think, to help our customers and non-customers, because we allow non-customers to use that savings tool as well at no cost.
Yeah, I just wanted to circle briefly back to the trusted advisor and this topic. Jen, I wanted to get your input as well around this, around short-term liquidity and trusted advisor and how these things link up.
Yeah. And I just saw a question around the money market, and I would love to hear, Jonathan and others' point of view on that. But because one of the things that I think is really big now is those that have money in the bank. They aren't taking that out because they want that liquidity, and they're looking at their financial institution as stability, right? And one great thing that I have seen other financial institutions do is actually reach out to those who do have some, high balances, and offer a large yield to put an amount in a money market account. So, deposit 10,000 or more into this money market account and get this great yield. And I think that those are things that, you have these great financial advisors and wealth management staff within financial institutions, and just looking at, taking some of their advice and educating those who may have those higher deposits in the bank, and how that offer could benefit them as well as the financial institution, right? Getting that deposits. And of course, that means that money is potentially being, taken from, stock or just, other financial institutions or whatever. But that's an awesome offer and a great guided advice to members and customers.
Right. So part of becoming that trusted advisor is not just what you have with me, but what do you have elsewhere? And showing you how, using the technology, how you can grow that. And that goes to the question I mentioned earlier about, I want the best rate, and can you automatically put me there? It may not be in a savings account. It might be, here's a money market account, or ladder up some CDs and you're going to get X rate. And I don't know about anybody else, but I tend not to want to think about these things. I want somebody to think about it for me and tell me the best thing, because, I have a million other things to do, like everybody else. And that kind of advice, that's reliable, and not just selling, we have this car loan rate, great, 5%, and you just bought a new car, So, but taking it, as Mike has talked about and Kellie's talked about, data, personalizing it and pushing it where the customer is, I think really starts to build that trust around the financial institution. So we've kind of been pushing towards this idea, in our discussion so far, but being competitive and flexible with rates is really going to be a key strategy, obviously, going forward. I mean, that's clear from what we've been talking about. It's not enough to have the best rates, but how to use technology to push us there. I know at LAFCU, you guys have been doing stuff to stay competitive and drive demand for your deposit rates, Kellie. How do you stay on top of this, and how do you become more flexible around rates?
Yeah, I think it kind of just goes back to constantly revisiting your data, where you currently are, where you want to be, and looking at the market, the industry too. Where is everything? Where are the rates? Where can we get leverage? And then coming up with a new strategy. If you have an existing one, what's going to happen next? If maybe that strategy is an old strategy now because it just doesn't work anymore with the way that the industry is and the way that your data shows. So it's constantly revisiting and having those discussions with your key players to meet those goals that you're wanting to get to.
How do you, and this is, I think we also talked about this a little bit earlier, but specifically about Timberland and maybe the credit union, how do you target these flexible rates or different rates? Are you just rolling them out to everybody, or are you doing some analysis on, you know, who's been stuck with, say, for example, you know, $10,000 in savings, and hasn't moved it? I mean, how can you talk, Jonathan and Kelly, a little bit about how you're doing that?
That's a great question, Stessa. I wish I had a great answer for that, but I think tying back to one of the other questions with money market rates versus CD rates, what we've been trying to do is look at the relationship. And for instance, you know, if someone has $100,000 in a money market account, they may want that to remain liquid, but they also want the highest rate. So sometimes what we're offering is we're saying, well, when they come in and they say, well, we see this 5% rate at this other credit union or bank, and we're saying, boy, we can't do that, but maybe we can offer, you know, we can increase their money market rate to 1%, and then we can offer them a CD at 4%, which is less than the 5%, but the net of it is the customer is going to earn more interest over time with our, you know, switching up the rate component. And so a few things like that we've been doing, but it's tough to know, does the customer really want just the highest rate, or do they want overall better interest, or they just want to be heard? It's just, you just have to talk to each customer. Sometimes they feel it's great and they feel like you're their trusted advisor, and other times they go and take the best rate. But most of the time customers understand that we can't always be the highest rate in town.
Right. I guess I'll be the devil's advocate. How do you reach them if they're not coming into your branch and say, I want a higher rate? Do you reach out to them proactively? And this is for Kelly or Jonathan.
Yeah.
Do you have ways of doing that, whether it's you know, just digitally or reaching out with a phone call? How do you reach them? Because you don't want them to go, oh, this is such a terrible rate, and search out something and then move before you even know what's happened.
I think that's something that we all have to improve on. It's just that we don't have the answers on. We do have reports and we have data that shows, okay, these CDs are coming up, or these people are moving money. But you're right. I mean, it's so easy to move money now. We might not even know when it's just gone. And so I think being proactive with our staff, that's why our staff is so important, because we have all these branch managers that look at these reports and they proactively call, and then you've got a customer for life if you're looking out for them. And
Right.
I think we just need to improve on that. It's a great point.
Yeah. And that goes back to the whole trusted advisor. Like, if you're looking out for my money, that's really what I want from a financial institution. I don't want it to get stolen. I don't want to lose it. And I want to, you know, grow it, right? I want it to be safe and secure. And that's always been the secret bullet that financial institutions have. I wanted to give you, Kelly, a chance to talk to that too, if you wanted to.
Sure. Yeah. I think that it just, we need to be flexible with what we can do. You know, we've got members where we want to retain them. We want their money to stay with us. You know, what are we offering them to stay with us, you know, as an incentive? And then for acquisition as well, you know, what are we doing for the new members or even the younger members, you know, looking at it full picture at a younger age, or members who have already invested their money in giving them better options. Maybe where they are right now is not like the best option for them. And we know that they can do better, and using those digital channels and sometimes direct mail. So we know that sometimes not all members are going to respond digitally. So you do have that pocket of members that you still need to kind of cater to certain types of marketing messages to reach that message to them. And then on the other hand, it's just reaching out in all forms of digital communications.
Well, that's an excellent segue to the next strategy, which is around rewarding customers and members for their relationship to you, because I think rates probably aren't enough anymore. And at the top of our discussion, Mike mentioned the larger banks going back to, I guess you could call the toaster approach to banking. You know, so how can banks and credit unions reward their members for the relationship in a meaningful way? And I guess, Mike, let's start with you.
Yeah, well, for a lot of community banks and credit unions, free checking has been indeed popular part of their strategy and probably will remain that. The big banks will likely continue to try to woo account holders and depositors with those big bonus advertisements. Come to us, do these 10 things, and earn $500. But rewards are a phenomenal way to attract and retain consumers, customers, members, and not traditional rewards checking. You've got to think about the entire relationship, and you've got to reward for all the aspects of that relationship, so that you're differentiating yourself from everybody else. Yeah, we've been successfully, our clients have been successfully using rewards to attract, retain, and increase profitability for years. And there's all sorts of ways to do that. A very popular way is to utilize that to drive debit card spend and debit card activity, and making sure that that debit card is top of wallet for all of your account holders. So I think that's there's a huge ROI associated with utilizing rewards. I know in talking to a lot of different people, and it doesn't matter what part of the income or net worth spectrum they are, people get joy out of getting picking out some sort of product or gift card with points.
Right. And as a user of my local Wawa rewards card, and that's a convenience chain in the Philadelphia area, I can say that they don't understand the rewards that I want, because they're always offering me free things that I don't drink and I don't eat. So to that end, I mean, don't banks and credit unions really have to focus on the rewards that are meaningful and valuable to the various members and customers they have? And it might be a toaster for somebody, but it might be, I don't know, game points for another segment, or something else. Actually, I don't want to suggest it, because I think that's the big unknown here.
Well,
and certainly somebody in the questions asked again around keeping up with rates is nice, but how are you going to keep up with the larger banks and the neobanks who really can jack their rates up much higher because of a variety of reasons? So I want to kind of push back that this might be an even a bigger way to differentiate. Let's see.
It is, and you know, partnering with the right provider is obviously key. We at Velocity, we utilize, as we've talked about, data, and data helps act as a crystal ball, if you will, for us. But more than half of consumers want to be able to redeem their points for gift cards. They want a Starbucks gift card. They want a gift card at their favorite airline, or whatever the case might be. And then they get to decide how and what they purchase. At the same time, we still have a lot of folks that are redeeming points for brand name products that perhaps they might not spend money for, but the perception is, hey, they're able to get X, Y, or Z at for free with their points, and they feel like that value is greater than exchanging it for a gift card and redeeming that gift card for whatever they would already spend their hard-earned money on.
So I think one of the other things you're kind of alluding to is, in addition to the technology, that banks and credit unions have to have some partnerships in place, whether they're with other vendors or other providers, merchants, retailers, to do that. I know we're kind of starting to run a little short on time, so I want to make sure we get to Jen and see what your thoughts are on rewards and how you see banks and credit unions helping their customers with this?
Yeah, I think anytime you incentivize, it works. And I just saw a comment come up, cash rewards win every time. It's so true. I think it is cool to have the tools in place to be able to track how the consumer or user is doing in regards to getting their points and rewards, along the lines of even just what is the behavior you're trying to get the consumer to take, and then ensuring you have a way of, as they're taking those, that they can clearly see as they go through a process how their points or rewards are adding up. I think that's a really important, because it does drive behavior. So why not have that in place right in front of them as they're going through those steps that you're truly trying to get them to accomplish. I think even with education, sorry.
No,
Even
that's
with
okay.
education, that's a really great one. I mean, have a guided journey for education and incentivize them, and then have a survey at the end to potentially get some additional information to round out what your next communication may be. I mean, it's all about rewarding the behavior that you want the user to take. Sorry.
Right. No. So that's really, Jen, that's a great way of tying actually all these things together, so they can't be just siloed efforts. A strategy, all these things are strategies, but they're not siloed strategies. So it's really important that when you're looking at flexible rates and you're looking at becoming a trusted advisor and you're looking at rewards, that you think of them working together. Which kind of drives to our last strategy, which is about getting better at referrals. I mean, how do referrals factor into your bank's growth plans? I mean, because if you want to grow your deposits, people need to tell other people about it. I don't want to use the word viral, but you need that kind of synergy, right? So I guess, Jonathan, how does referrals factor into your plans to grow deposits at the bank?
Yeah, well, we really promote referrals a great deal with our staff, and then we ask our customers to refer other potential customers to us. And that's on the consumer side. On the business side, we focus heavily on our staff talking to their customers and asking for the business. I mean, we're just frequently asking to refer their friends, and we use the Velocity solution on the consumer side to refer things. But I just real quickly want to go back to the last topic and say that we've used the debit card rewards program with Velocity for over 10 years, and it's helped us remarkably because it's grown our checking account base. So I talked a little bit about CD rates, but growing our checking account base has lowered our cost of funds. So you've got higher fees with interchange, you're lowering cost of funds, you're expanding the relationship. And then at that point, when the customer's happy, we ask for the referral. So it kind of all works together, and it's worked remarkably well. It's amazing how that all works together.
Okay. So the obvious question I have is, do you reward customers who refer new customers to you? Okay.
We do. But
I just wanted to complete that loop.
Yep, we do. Nothing like the big banks with the big dollars, but we have points in our referral program, and it works great.
Yeah.
I love it.
Yeah.
I think that goes back to the whole idea of it's about the entire relationship, and it's about rewarding all of your account holders based on that relationship. And it's not just a one-trick pony. It's not just rewarding. It's not just a rewards checking. It's not just a rewards debit card. It's part of the entire relationship and how you approach it with your consumer base.
I think that's really important to note, as we wrap up here. I mean, these are all really good strategies, and implementing them, only at the branch or only on the mobile app is probably not going to help banks and credit unions be competitive in deposits. But being able to use these strategies in all different modes, in all different channels, is really going to push the credit union and banks to reach their customers and prospective customers, everywhere, because that that person might get a referral because they said, oh, I need a new car loan, or, you know, my savings rate at this other bank is terrible. What should I do? And then they're going to go check out your website or your social on Facebook or whatever it is that they use to see if you're there and what you're telling them. For sure, the deposit environment is really different now. It'll probably be different in 6 months. The future is hard, if not impossible, to predict, but we can try. Some things that we know are going to happen because of this. We can see in the future, but by implementing these strategies, positioning the financial institution as a trusted authority, providing some short-term liquidity options, you know, so that your customers don't have to seek out payday loans, providing, you know, competitive and flexible rates. Being flexible is I think a new idea for many institutions, and then improving your ability to drive referrals. All of these will help you not only retain the deposits that you have, but grow what you have and grow it organically, without having to look at cross-sell opportunities. This is like moving on from that traditional view to something that's organic and very strong foundation for differentiating and moving forward. I did want to take a few questions if we have them. I think I've tried to answer the ones that we had as we were going through because they related to the topics. But if you want to open it up for additional questions, we did have a question in here around less interchange and rewards programs. Did somebody want to take that as a question? What will happen because of less interchange and rewards? Will that impact things?
Yeah, happy to take that. I'm guessing the question is related to the potential change in regulations as it relates to credit cards and the interchange rate on credit cards. Currently today, the credit card rates allow the collection of the funds that pay for those rewards. That's not the case on debit card. There's just not enough interchange in debit card programs to pay for those reward programs. So the Chases, the Capital One, the American Express, they're all getting 50, 60 basis points or more. And even on the merchant statements, it even shows on the merchant statements how much the merchants are paying for these various reward programs. So obviously, as the interchange or if the interchange tightens up, that will have a huge impact on credit card reward programs.
Also related to that, and somebody made a comment in the chat about rewards programs being impossible for community banks to afford, and I guess because you can't really actually compete with the programs that the large banks have, and you really have to create it in-house. I don't know if you, Mike, or Jen, or even Jonathan or Kelly want to address this.
I'd love to defer that question to Jonathan, since Jonathan's been running our rewards program for a number of years.
Yeah, we've not found that to be the case. I understand looking at it, that might look like a big expense, but you can start off slowly and grow it. And there hasn't been 1 year since inception that we haven't made more money than it costs to put out to customers, and customers love it. So I think there's a couple of things you get with your customers. You get the benefit of them continuing to work with you. Plus, I think the cost is fairly nominal compared to the potential upside in the interchange.
Do you look at the costs and benefits in terms holistically, outside of just the specific program? So if a customer is getting these rewards, but then also using other services, do you look at that in terms of profitability?
Sure. And then the
Okay.
deposits are key as well,
Right.
because those low cost deposits are really, really valuable, especially in an environment like today.
Yeah, I bring that up because I think bankers have tended to look at their product and service silos. You know, how much does it cost me to do X without looking at the fallout across the relationship, across the product life cycle? Like if I give this teenager who has an account under their parents this kind of rewards, that, you know, maybe that just, I'm there for them when they need a car loan, right? I'm there for them, you know, if they need student loans or whatever it is that they're going to need financially. So it might make sense to look at it that way. And I think that's taking a different, more dynamic, holistic, which I hate that word, but holistic approach to what the relationship is. So instead of checkbox, you have all these products, do I have the relationship with the customer or the member?
Yeah. I think if you included all that, these reward programs would be a tremendous ROI. I mean, more than just looking at it in a silo, but even on a silo approach, it makes sense. But I agree with you, Stessa.
Yeah.
I think that's a great point.
Yeah. Yeah, interesting. I know a number of years ago, there was a bank in Malaysia, Indonesia, that had saving circles, and they gamified it, and they got people to save more by counting up how much each person saved. And that worked in that particular culture. And similarly, I think that's what you're talking about. So I wanted to wrap up because it's the top of the hour, and thank everybody on the panel for their time and their great insights and examples, and thank everybody on the webinar who attended today and had some really great questions to make this even more interesting. Growing your deposits is possible with this, using these 5 strategies and more. Happy to take questions. If people want to ping me on Twitter or wherever else you are these days, and look forward to an email in your inbox tomorrow. Thanks again for attending.